what are your thoughts on the money market fund with Fidelity? It says it'll pay me 5%. So keep in mind that the money market fund you mentioned is a mutual fund in Fidelity that invests in a short-term debt products like Treasury bills, commercial papers, and CDs, right? If you don't know what those are, that's okay. I know when a lot of people hear the words mutual funds, they automatically think it's all stocks or a mix of stocks and bonds. But Fidelity has a list of money market funds that allow you to invest in short-term debt that focuses on federal agency notes, repurchase agreements, and they are generally considered safe investments. But you have to pay attention to the interest rates because they do come with some risks. And this is actually a video I wanted to make a while ago, but let me give you the breakdown anyway here so you have a full understanding of it. There are three different names when it comes to Treasury securities, or what we call government issued fixed income securities. Okay, there's the Treasury bonds, Treasury notes, and Treasury bills. Treasury bonds are long bonds because their maturity dates are between 20 and 30 years. And you're going to receive a fixed interest payment every 6 months for investing directly in Treasury bonds. You don't pay any state or local income taxes on the interest you earn, but you will pay federal income tax based on your marginal tax rate on bonds, bills, and notes, okay? And you can also sell a Treasury bond before maturity, but the volatility is higher than a Treasury note or a Treasury bill. So it's not guaranteed that you can sell a Treasury bond at its face value. So if you buy let's say a 30-year Treasury bond at $1,000 and the value goes up to $1,020, then it's trading at a premium. But if it's trading at, let's say, $980, then it's trading at a discount. So if the price is above the face value, then your yield is going to be less than the coupon rate, right? And you have to keep in mind that Treasury bonds are considered safe investments, but it comes with inflation and interest rate risks. So, and if inflation goes up, like it has been since 2022, then you're not going to have the same purchasing power that it did 30 years ago, right? And if interest rates rise, then the price of your bond will decline. And that's going to be a problem when you can't sell it for face value. And the longer your maturity is, the more the bond will be affected by the rising interest rates. And I know I'm getting super technical here, but let me know in the comment section if you enjoyed this type of content. And I talk about this in my private client program. So feel free to sign up for the one-on-one session by visiting fidelity.com/coaching. But anyway, there are also Treasury notes, okay, that have a maturity date of 2, 3, 5, 7, and 10 years, okay? So Treasury notes also comes with biannual interest payment, but offer lower yields than a Treasury bond. So the 10-year Treasury note is what CNBC, Bloomberg, all they talk about because that's what people look at as a benchmark to set mortgage rates. So when inflation picks up, so do fixed mortgage rates, right? Now, Treasury bills is what you're talking about here, okay? Now, these maturity dates are for let me think, 13, 26, or 52 weeks, right? So they're short term. So they don't pay you interest payments every 6 months like Treasury bonds. So it's a short-term debt obligation or a short-term loan issued by the federal government. So when you buy a Treasury bill, you're going to pay less than its face value and then receive the face value at maturity. What I like about the Treasury bill is the fact that it's short-term and high liquidity, and they're supposed to offer lower returns than Treasury bonds or Treasury notes. But since 2023 and still in 2024, short-term treasuries actually have yielded more than the long-term treasuries. And you probably heard it from other people talking about the inverted yield curve. And this is what I'm talking about. A money market mutual fund that you're asking about will pay you an interest payment every month. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budgeting app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $300,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. So let me go ahead and pull up the Fidelity short-term FDRXX. So let me pull that up and show it to you guys here. So in full disclosure, I do have money saved in short-term treasury, but in a mutual fund with T-bills, Treasury bills, offered on the secondary market. This is not in any form of financial advice. I'm just here to show you how to read the chart, okay? So anyway, I think there's over $27 trillion just in US Treasury securities in 2024. But when you read that it's 4.98% right here for 7-day yield, it just means that the average income return over the previous 7 days is 4.98%. It's the total income net of expenses divided by the total number of outstanding shares. That's too technical, but just bear with me here. If it's yielding 5%, you got to keep in mind that this mutual fund charges you, let's see, there's an expense ratio right there. There we go. Gross expense ratio of 0.38% in annual expense ratio. So it's really paying you 4.62%-ish in net, right? You always have to keep an eye on the expense ratio when it comes to investing in a mutual fund. So if you click on, let's see, fees and distributions, you're going to see that this mutual fund pays you dividends every single month. It's really interest payment, but it'll say dividend on there. The net asset value is always going to be $1, but the share amount is going to be different every time. And remember that how much they pay you will also depend on how long you put the money in the mutual fund, right? The rates will also change because the mutual fund is tracking the overall short-term interest rates. And because the net asset value is always $1, so when you sell this mutual fund or money market fund, you're not going to owe taxes on the capital gains, but you will owe federal income tax on the interest that you received. And it's actually gonna say dividends or dividend distributions if you invest in this one. Again, I'm not sponsored by Fidelity, and I'm just showing you this as an example. If you have Schwab or Vanguard, they have their own version of the money market fund that you can check out. But I hope that kind of helps out. And there are other Fidelity products that focus only on Treasury securities. So please feel free to do your own research when you get a chance. And depending on when you're watching this video, the yield could be half of where it is now, or maybe even higher. And you'll need to pay attention to the rates and the expense ratio you're paying for. Just because it pays 5%, it doesn't mean that you're gonna earn 5%. If you don't account for the management expenses, you're not really getting that 5%. You're probably getting like 4.6%. You have to pay attention to the interest rates too. If you're going to save a significant amount of money in it, just make sure you know what you're using it for. I use it for my traditional IRA to keep my money safe so that I can make the backdoor Roth IRA conversion every year. Some people use it to save for the down payment of their home. I'm being very intentional with my savings, so you need to do the same before you just invest blindly into the market. Great question though.